Shall we?
Sir. Yeah.
Okay. So let us go ahead and take an example on preparation of a group cash flow statement. Okay? Yes, ma'am.
Okay. Question 6. Extracts from the consolidated financial statements of the AH group for the year ended 30th June 20XY are given below.
Okay, let us have it as A group, okay, in the AH. Yes, ma'am.
Consolidated statement of profit or loss for the year ended 30th June 20XY. Revenue, all $1,000. Revenue is 85,000. Cost of sales is 60,750. So we have a net profit of 24,250.
Okay.
Then we have operating expenses of $5,650. So profit from operations is 18,600.
Okay.
Then we have finance cost of 1,400. So the profit before disposal of property is 17,200.
Okay.
Then the disposal of property, refer note 2, is 1,250.
Okay.
So the profit before tax is 18,450.
18,450. Okay.
Less tax of 6,250 will give you the profit for the period of dollars 12,200.
Okay.
Attributable to non-controlling interest is 405 and owners of the parent is 11,795.
You saw this? Now they're given something called a consolidated income statement, in which they're shown the net profit, that is the net income before tax. They're given the net income after tax, and also of these the net profit, how much belongs to the non-controlling interest, the minority shareholders, and the profit that belongs to the shareholders of A Limited, the parent entity. Understood? You know what is that 405? That is nothing but a profit made by the subsidiary or the subsidiary companies, depends, subsidiary or subsidiaries. On that we apply 20% or 30% a non-controlling interest, and that is a profit attributable to non-controlling interest. Is that fine? That is 405. You know what we normally do in working note number 4 in our full-fledged examples, non-controlling interest. NCA at acquisition, and then we add the NCA share in the post acquisition profits. We add, right? That is at 405. If it is a newly acquired subsidiary, otherwise it's just a profit made by the subsidiary that belongs to the minority shareholders. Is that fine? Next.
Note, there were no items of other comprehensive income. Next, we have statement of financial
Basically, no revaluation surplus, right? That goes into other comprehensive income. Next.
Statement of financial position with comparatives at 30th June 20X5.
Okay.
Okay. For 20X5, current year and 20X4 is given.
Okay.
Non-current assets, property, plant and equipment, 50,600 for the current year and 44,050 for the
Previous year. Next.
Goodwill, note number 3, rupees 5,910 for the current year and rupees 4,160 for the previous year.
Okay, next.
Then we have current assets, inventories, 33,500 for the current year and 28,750 for the previous year. Next we have trade receivables, 27,130 for the current year and 26,300 for the previous year. Next we have cash and cash equivalents, 1,870 for the current year and $3,900 for the previous year. So we have the total given.
Okay.
Total
Then
assets is also given.
okay.
Then we have equity and liabilities. Equity shares is 20,000 for the current year and 18,000 for the previous year.
Okay.
Share premium is 12,000 for the current year and 10,000 for the previous year.
Okay.
Retained earnings is 24,135 for the current year and 18,350 for the previous year.
Okay.
We have non-controlling interest amounting to rupees 3,875 in the current year and 1,920 in the previous year. So we have a total equity given. Then we have non-current liabilities, interest-bearing borrowings, 18,200 for the current year and 19,200 for the previous year. We have current liabilities next. Trade payables, 33,340 current year, 32,810 previous year. Interest payables is 1,360 for the current year and 1,440 for the previous year.
Okay.
Next we have tax, 6,100 for the current year and 5,450 for the previous year. And the total is given.
Okay.
We have notes. 1. Several years ago, AH acquired 80% of the issued equity shares of its subsidiary BI.
You saw that I bought 80% interest in company that is by the name B. It's given BI. Okay. Several years ago, not in the current year. Yes, my 80% interest. That means what? Balance 20% non-controlling interest.
On 1st January 20X5, A Limited acquired 75% of the issued equity shares of C Limited in exchange for a fresh issue of 2 million of its own $1 equity shares issued at a premium of $1 each.
Okay, in the current year, I bought a 75% interest in CJ, that is in C Limited, that is on 1st January 20 X5. I think the balance sheet date is 30th June X5,
June.
the current year end. I bought 75% of the equity interest in C Limited on 1st Jan X5, that is 6 months before the year end. Is that fine? That is in the current year. And as consideration, what I paid?
2
I
million.
issued 2 million equity shares, face value $1 at,
Premium of $1.
that means at $2 each. Now, what is 2 million into $2?
4 million.
It is 4 million,
Share.
or $40 lakh worth of shares were issued. That is $40 lakh including premium. Or you can say 4,000 in thousands. Now you can see in the balance sheet also, just the share capital equity has increased by 2,000.
Yes, sir.
And what about the share premium? Another 2,000, all 4,000. That means a 4,000 increase is nothing but is investment made in the subsidiary company. Yes, ma'am.
Yes, sir. And 2 million in cash.
I also paid another $2 million in cash. Therefore, I can say my total consideration is how much? It is 2 million shares into $2 each, 4 million, or 4,000 in thousands, plus another 2 million, that is 2,000 in thousands in cash. In all, I paid 6,000 in thousands as purchase consideration. Next.
The net assets of C Limited at the date of acquisition were assessed as having the following fair values.
Okay.
Property, plant and equipment, 4,000.
He has given this information for you to calculate any goodwill arising on acquisition. You get it?
Yes, sir.
He has given the fair value of the identifiable assets acquired and liabilities assumed. Yes, ma'am.
Property, plant and equipment, 4,200.
Okay.
Inventory, 6,650.
Okay.
Trade receivables is 1,300.
Okay.
Cash and cash equivalents is 50. Trade payables is 1,950, and tax part is 250.
250.
Yes, sir. That's all for the.
No, then after that.
Point 2. During the year, A Limited disposed property, plant and equipment for proceeds of $22,50,000. The carrying value of the asset at the date of disposal was $10 lakh.
You saw that? So we sold, that is we sold rupees, rather $10 lakh worth of property, plant, equipment, book value, not cost, book value, for how much? $22 lakh and 50,000 means there is a profit of $12 lakh and $50,000 or 1,250 in thousands, which is there on the income statement. Next.
There were no other disposals of property, plant and equipment.
Okay.
Depreciation of 79,50,000 was charged to the consolidated statement of profit or loss in the year.
Okay, the depreciation for the year will be a part of either the cost of goods sold or part of operating expenses. Is that fine? Got it?
Yes, sir.
And what is the amount?
79,50,000.
That is a depreciation for the year on fixed assets. Next.
Point 3. Goodwill on acquisition relates to the acquisition of two subsidiaries. Entity B was acquired many years ago, and goodwill relating to this acquisition was calculated on a proportion of net asset basis.
That is in B Limited.
B
Okay,
Limited.
next.
Goodwill relating to the acquisition of entity C during the year was calculated on full goodwill basis.
That means what? I decide to fair value the non-controlling interest. The full goodwill method here, not partial goodwill. Next.
On 1st January 20X5, when C Limited was acquired, the fair value of the non-controlling interest was $17,50,000.
Very good. 1,750 in thousands. That is supposed to be the fair value of non-controlling interest as on acquisition date. Next.
Any impairment of goodwill during the year was accounted for within operating expenses.
You saw even the impairment of goodwill is a part of operating expenses. That's given in the income statement. Next.
Required. Prepare the consolidated statement of cash flows of AH Group for the year ended 30th June 20X5 using the indirect method.
Now listen. Whenever there is an example on you preparing a group cash flow statement, you got to take care of some 2-3 items. One, what is that? Regarding goodwill. You got to calculate the goodwill on any acquisition made in the current year, and then find any impairment of goodwill, which is a non-cash item. to be added back while calculating operating cash flow. That's one. Number two, you got to calculate any dividend paid to the minority shareholders. So that can be found out by preparing a schedule, a statement, or an account for non-controlling interest or for the minority interest. That is number two. And number three, you got to find any dividend paid by the parent or the holding company to their shareholders. Is that fine? Three things you have to take care of. What is the first one? Goodwill. And any impairment of goodwill. Number two, dividend paid to the non-controlling interest. And number three, any dividend paid by the holding company to the shareholders. So whatever dividend paid by subsidiary to the holding company will not come. Why? It's intra-group, right? Within the group, there's no cash outflow. Only when dividends are paid by the holding company to their members, and that is a cash outflow from the group. Is that fine?
Yes.
From the entity. Then one more issue. Now tell me, Sneha, let's go to the balance sheet. No? Go to the balance sheet.
Yes, sir.
I have a question for you.
Yeah.
What is the inventory opening balance?
We have opening is 28,750.
Opening is 28,750. Okay. And what is the closing balance?
33,500.
33.
1,500.
What is the increase?
4,750.
Very good. People will say this increase, I will adjust as a working capital change. No, that's what people do, right? See, it's not no because you are telling this because I'm highlighting this point. Okay. So people will do this.
Okay.
Had I not raised this point, you will do this. Because that is rote learning. The change in inventory should be adjusted during operating activity. Why do you adjust? To tell me. Remember the other day I said we adjust because to find what? The purchases for the year. Then adjust for accounts payable to find the payment to suppliers. Remember the other day?
Yes, sir.
I explained how it gets adjusted. We adjust even for debtors out purpose to find the cash received from debtors. Understood? But now there is a problem with our AC also. Okay. So now there is a problem. I'll tell you what is the problem. This increase in inventory will include what? Exactly the inventory which is a part of acquisition, which is nothing to do with our cost of goods sold number. Now these are inventories that are held by the subsidiary bought by me on 1st January. Yes or no?
Yes.
What is the amount?
1,650.
Is there, right? You should remove that and then adjust for the increase. If you don't remove, you're adjusting even for inventory of the subsidiary, but that would affect their cost of goods sold prior to the acquisition. Yes or no? Got it? Therefore, I should remove that and then adjust it. So these are the things you got to take care of. What is the first one? Goodwill. Number two, dividend paid to non-controlling interest. Number three, that's what, goodwill including impairment. That's what I meant, Pavitra. Goodwill, calculation and impairment. And then number two, dividend paid to non-controlling interest. And number three, need dividend paid by the holding company to their shareholders. And four, while working out the working capital changes, take care. And then one last issue will be, sir, what is the amount to be shown in my investing activity? Because I never had any control over C Limited, right? Sure. I am obtaining control only in the current year, 75% acquisition. Got it? So under investing activity, I'll show investment in C Limited. How much? I paid in all 6,000 in thousands, right?
Yes, sir.
Remember, I issued shares worth 4,000 in thousands dollars and also 2,000 in thousands in cash. Now, which item will be shown in the cash flow statement? Under investing activity, investment in CJ, what is the amount? That is amount paid in
Cash.
Cash how much? $2 million is wrong because now tell me, is any cash in the subsidiary I got? There see the list of assets acquired. Therefore, even though I paid 2,000 and thousands to you people from whom I bought 75% stake. Remember who are the three people? Subhash, Sneha and Pavitra, always. I bought 75% shares from you people, right? Of the shares outstanding in your company. I paid 2,000, that is $20 lakh in cash. But remember, I paid you 20 lakh. But I got access to your company's cash. How much?
50,000.
Therefore, 20 lakh minus 50,000, 19 lakh 50,000 will be shown as investment in CJ. So where is it all given, sir? I'll show you the para, don't worry. Trust me. In God we trust. Okay. So it is 1,950 in thousands. Got it?
Sir.
So now we shall go ahead and take on the solution, but for these. This sum will be like any other cash flow statement. But here one more point. There is no accumulated depreciation account maintained by the company for property, plant, equipment. Therefore, even the depreciation for the year will be shown in the asset account itself. The entry will be depreciation account debit to asset account. It will reduce asset account. Right? Got it? Now, but in this sum, we will not prepare any T-shape account. We will prepare what? Addition and subtraction. Common sense. Fine. Shall we?
Yes, sir.
Well, let's go ahead and take on the solution. First, we have to go through the working notes. There are 7 working notes in the solution. What I will do is, I'll discuss the first 4 working notes. Is that fine? Then pause the recording and let's put down the 4 working notes. Then I'll discuss the next 3 working notes. Again, you pause the recording and take down the next 3 working notes. And then I will go through the group cash flow statement at the stretch. Is that fine?
Yes, sir.
Shall we?
Yeah.
Yes, ma'am. The first working note.
Interest paid.
You saw that? I want to find the interest paid to be shown under financing activities. Whereas in IFRS, you are given a choice. You can show interest paid under operating activity, after minusing income tax paid. Or you can show it under financing activities. You have a choice.
Yes, sir.
Whereas in US GAAP, we show the interest paid on loans under operating activity.
Activities.
But we stick on to what? In our IND AS, under financing activity. That's it. Is that clear? Now, how to find interest paid? Very simple. Now, tell me, what is the opening balance of interest payable?
1,000.
No, you can read from the working note itself.
Okay. 1,000.
People at home can turn the page and go through the handout. Is that fine? Let this be on the screen, Sneha. Don't
Okay,
go
sir.
back to the question. What is the opening balance?
1,440.
That's amount. That is the amount payable. That's interest payable opening. And then add interest expense for the current year. That's also payable, right? How much is there in the P&L income statement? What is the amount finance cost?
1,400.
Exactly, that is added. What is the opening balance, Neha? 1,000?
400.
Very good. Add expense for the year, how much?
1,400.
In all, 2,840 is the total amount of interest payable to the lenders. But of this 2,840, what is still outstanding at the end of the year?
1,360.
Given, right?
Yes, sir.
That means the difference should be what? Amount
Paid.
of interest paid. Balancing figure. What is the next line they wrote?
Sir?
Interest?
In the next.
No, in the same working note,
Yeah,
1,440 opening balance.
Then we have profit or loss 1,400.
Nothing but the finance cost for the year taken from profit and loss account. How much?
1,400.
Very good. And then
Interest paid is balancing figure.
balancing figure. What is the carry forward amount?
Balance carry forward is 1,360.
Therefore, the difference will be interest paid. How much?
1,480.
That is the amount of interest paid to be shown under financing activity in your group cash flow statement. Is that clear?
Yes, sir.
Working note number 2.
Income tax is paid.
Very simple. We have done this earlier. What is the opening balance of income tax payable given in the balance sheet?
5,450.
Okay. Now, there will be 2 additions. I'll tell you why 2 additions. One is the income tax debited to profit and loss account for the year. And also, the income tax liability of the subsidiary that acquired, no, CJ.
Okay.
It'll increase my tax payable. See, no, earlier it was payable by CJ to the, no, the group is responsible, right?
Yes, sir.
Yes?
Yes, sir.
Read what is given next line. Add.
Profit or loss is 6,250.
This amount is taken from the income statement, income tax expense. Then,
Next we have for the new subsidiaries 250.
because even that is now
Yeah.
payable by the group, from the group standpoint. How much? 200?
50.
Then add these 2 numbers. Now take a calculator, guys. What is the opening balance, Neha?
5,450.
And then add 6,000
250.
and add another.
250.
What is the total?
11,950.
This should be the closing balance. But what is the carry forward given at the year end?
6,100.
That means the difference is the income tax paid in the current year. How much?
5,850.
That's all. Very simple. Don't take the trouble of preparing a T-shape account. Don't tell me they're going to give 1 mark for that. Okay, no way. They're not a bunch of fools sitting out there. Fine. All these are given. You're supposed to know this. You can't earn 1 mark for this. Okay, you have to know this at this level. Income tax paid. How much? 5,000?
5,850.
Because we know the carry forward amount, right? Working note 2 is done. Working note 3.
Property, plant and equipment.
Very good. Very, very simple. Same. Any increase, added to the asset. Any decrease, you subtract. I shouldn't say this, okay? You should know. Opening balance, how much?
44,050.
Very good.
Dollars.
And the next line.
For the new subsidiary, 4,000.
Exactly. That is the note belongs to me, right? Add that. Then
Depreciation less 7,000.
depreciation, you subtract for the year. How much?
7,950.
That's it. And then there is a
Disposal.
asset disposal. You can reduce the book value straight away. How much?
1,000.
Don't bother to show the profit, nothing. Book value of the assets sold. Gone. Now take your calculator, Sneha.
Yes, sir.
And even the people watching the video. What is the opening balance?
44,050.
Okay, plus.
4,200.
And then minus depreciation. Subtract. Also minus disposal 1,000. So what should be your closing balance?
39,300.
This should be your closing balance. Carry forward. But what is the carry forward given?
50,600.
How, sir? Sudden increase, sir. Maybe the question is wrong. No. That means there is a
Purchase.
exactly purchase of property, plant, equipment in the current year by the group. If this could have been bought by the subsidiary or the holding, doesn't matter. Purchase is made in the year. Is that fine?
Yes, sir.
Not acquiring another subsidiary. These are purchases of property, plant, and equipment. How much?
11,300.
Got it? Huh? Very simple. Then working note 4.
Goodwill arising on.
Sir, this is very
acquisition of
easy, sir.
subsidiary.
What's I know, sir. Come on, sir. Let's go.
Fair
Full goodwill
enough.
method.
Yes.
The fair value of consideration paid.
Issued is, yeah.
That is under the shares issued. How much?
4,000.
It is 4,000. Cash paid.
2,000.
In all, 6,000 is a consideration. And then what is the fair value of non-controlling interest?
1750.
Very good. And if you want, you can make a total. And that is para 32A. How much? In all, 7,000.
7,750.
Very good. Now from this subtract the fair value of the net identifiable assets acquired. How much?
5,000.
Which is there in the question itself.
Yeah, total is also given as.
The 5,000 is given
Yes, yes.
in the question itself.
Yeah.
Very good. Yes. How nice. Okay, 5,000 you subtract. I think get a goodwill of how much?
2,750.
That's it. Is that clear? So guys, go ahead and just copy down working notes 1, 2, 3 and 4 in your notebook. Pause the recording, Sneha. Shall we?
Yes, sir.
Now let us go ahead and take on working note number 5, 6 and 7. Yes, ma.
Goodwill.
That is regarding impairment of goodwill, okay.
Okay.
Now again tell me what is the opening balance of goodwill?
4,160.
Very good. To this add the goodwill that arose
On acquisition.
on acquisition as on 1st Jan 20x5. How much?
2,750 from working note 4.
Exactly. Add both. That should have been the closing balance. How much? Adding both.
6,910.
But what is the closing balance given carry forward amount?
5,910.
That means the difference will represent the goodwill impairment, which is a part of operating expenses, which will be added back because a non-cash item. Understood?
Okay.
Got it?
Yes, sir.
How much?
1,000.
Very good. Impairment of goodwill. Then working note number 6. How to find the dividend paid to NCI? Very simple. Now, what is the opening balance of a non-controlling interest brought forward?
1,920.
Very good. Remember, NCA will always increase by, think of like partners capital account, no? Partners capital account. Have you done this?
Yes.
In your +1, +2, BCom first year, second year, third year?
Yes, sir.
Okay, or CA Inter. Somewhere you must have done, right? So, what is the opening balance of partners capital? Very good.
1,920.
And to this add 2 things. One is a profit that belongs to the partners,
Okay.
and also any non-controlling interest that arose in the current year. Adding on due to acquisition. Yes or no? Let's see. Add what? Next line.
And it's non-controlling interest arising on subsidiary acquired.
Exactly. How much? The at fair value 1,000.
750.
Add that. And also add the profit that
Add
belongs to the minority shareholders. How much? 405.
Five.
Adding all the 3 should have been the closing balance. Add up all the 3 numbers. How much you get?
4,075.
Should have been the closing, right?
Yes, sir.
But what is the closing carry forward given?
3,875.
That means the difference will represent the dividend paid, like amount withdrawn by the partners on drawings.
Okay.
I remember telling this while doing a sum on dividends. I'll say always subtract the dividend paid to NCA from NCA because like amount, like opening capital, add profit for the year minus any amounts withdrawn, closing capital. Got it? Have that in mind. Therefore, how much is the dividend paid?
200.
There is the amount of dividend paid by whom? By B and C, subsidiaries, to the non-controlling interest. Understood? 400, that is, dividend paid how much? 300.
200.
Or 200, okay. And then the next working is what?
Retained
Let's find the dividend paid by the holding company to their shareholders. So that what are you going to do? What is the opening balance of retained earnings?
18,340.
Very good. And then add the profit
Of,
made by the holding company that belongs to the, made by holding and all the subsidiaries, right? But that belongs to whom?
owners.
Owners of the parent entity, right?
Yes, sir.
How much?
11,795.
That is then income statement, which will include what? Not only my profits, also that 80% of B's profits and 75% of C's profits post acquisition after 1st Jan, right? All those will be there. Therefore, add that. Adding both, how much you get, ma?
30,135.
Should have been the closing, right? But what is the closing given?
24,135.
That means the difference will represent the dividend declared and paid by the holding company. How much?
6,000.
That's it. Done. That goes under financing activity. Yes, sir. Exactly. Understood.
Yes, sir.
And that is all with working note number
7.
7. Just pause the recording, complete working note 5, 6 and 7.
And pause, sir.
Now let us go ahead and go through the group cash flow statement. Yes.
Consolidated statement of cash flows for the year ended 30th June 20x5. Cash flow from operating activities.
Under that.
Under that, profit before tax 18,450.
This number can be taken from the income statement. It is available. Trust me. 18,450.
Yes, sir.
Then adjustments for
Less profit on disposal of properties 2,250.
it's a non-operating income. I'll subtract 1,250. Then
Add finance cost 1,400.
remember the interest expense that goes to P&L, no debit, added back, being a non-operating expense. Then
Adjustment for non-cash items dealt within arriving at operating profit.
you don't have to write all this. Okay, keep listing down the items in the exam.
Okay.
Fine.
Yes,
Next.
sir. Depreciation 7,950.
That's it. Add back. Next.
They have given decrease in trade receipt. I think before that.
You can also adjust for impairment of goodwill. See, here they have not bothered. I said no, some authors don't bother. See, normally we always do adjustments for all the items and show something called operating profit before working out changes. And then we will, find the cash from operations minus income tax paid. Right? Here is just jumbled it. Fine. Not an issue at all. Read.
Decrease in trade receivables 27,130 less 26,300 and less 1,300.
I said, remember, from while taking the difference, please remove the debtors acquired in the current year from the subsidiary, right?
Limited.
Well, adjusting for increase or decrease, you can follow this approach. Take the difference, closing minus opening, see what is the increase or decrease, and remove that what is acquired. Fine.
Yes.
Or easy way will be, can we go back to the question, Sneha?
Yes, sir.
I'll show you this.
Yeah.
Now tell me, Sneha, what is the opening balance of debtors? 26,000. Please key in this number in your calculator, 26,300. And then add debtors acquired from a subsidiary. How much?
1,300.
Add 1,300. How much?
27,600.
Should be the closing balance, right? But what is the closing given?
27,130.
That means what? There is a decrease of,
There's a decrease of 470 rupees.
that's it.
$470.
Decrease will be added. Done.
Understood, sir.
Understood?
Yes, sir.
This is the best approach I'll suggest. Take the opening balance of inventory or trade receivable or take trade payables, whatever, and then what? Opening balance, add what is acquired from the subsidiary, that is in a business combination, and compare that with the closing balance to find increase or decrease. I'll do one more example, Sneha.
Yes, sir.
Take inventory. Inventory, what is the opening balance?
33,500.
Very good. Key in that number.
Yeah.
And then add 33,
Sorry,
28, 750. Sneha, 28, 750 is the opening balance. And what is the inventory acquired in a business combination? 1,000.
650.
Add both. How much you get?
30,400.
Should be the closing balance. But what is the closing given?
33,500.
That means what? That difference will represent the actual increase in inventory from operations. Understood?
Yes, sir.
How much?
3,100.
That will be subtracted because increase in inventory, right? Current asset. I'll take another example. Take trade payables, Sneha.
Yes, sir.
What is the trade payables opening balance?
32,810.
And then add what is acquired?
1,090.
950 increase in payable because on acquisition, right? Add it. Liability don't subtract. Okay, add it only. How much total?
34,760.
Okay, but what is the closing balance given?
33,340.
It has decreased by how much?
1,420.
That is a decrease in trade payable to be subtracted.
Okay. Yes, sir.
Is that clear? I find that more comfortable than what they have done. Understood?
I think we discussed all the three.
All the three, that's what. Don't take interest and tax, okay? That is interest paid will come under financing, and then tax will be subtracted over under operating, right?
Yes, sir.
Can we go back?
Yes, sir.
Go to the
One
solution.
So depreciation 7,950.
After that,
Decrease in trade receivables 470.
okay, then
Increase in inventories is 3,100.
subtracted next.
Or subtracted, yeah. And decrease in trade payables subtracted 1,420.
Okay,
Then we have goodwill impact is 1,000 added back. So cash generated from operations is 23,500.
that is a cash generated from operations. The only thing they haven't shown what? Operating profit before working capital. That's okay, that doesn't matter. Okay, next.
Income taxes paid is 5,850.
Exactly.
Less. So we have net cash from operating activities amounting to 17,650.
Very good. Now comes another twist. Under investing activity, yes, ma'am.
Cash flows from investing activities. Acquisition of subsidiary net of cash acquired.
Which is nothing but what I discussed earlier, remember?
4,000 minus.
I will not consider all the 6,000 consideration because of that 4,000 is a non-cash. I issued shares, so don't consider that. So take only payment in cash 2,000, but minus $50,000 cash acquired. Net 1,950. Next.
Purchase of property, plant and equipment is working out 11,300.
11,300 is a purchase of property, plant, equipment for cash. Next.
Proceeds from sale of properties 2,250.
2,250 it is there in the notes, the question itself.
And
Sold for $22,50,000.
So net cash used in investing activities is 11,000.
Then just go to financing activity.
Cash flows from financing activities.
Okay, so what about issue of shares, sir? Don't show because we issued shares only for acquiring a subsidiary. Got it? I did not issue any shares for cash. Next.
Repayment of long-term borrowings 18,200 minus 19,000.
That is already in plain sight. You can see, refer to the balance sheet, opening, closing. It's going down. That means the loan has been repaid. Got it? I think there is a non-current liability, some long-term loan. Opening is a higher amount. Closing has come down. So the difference was the loan repaid.
Repayment.
Next.
Dividend paid by parent working note 7.
Parent working note 7 to their members. How much?
6,000.
Very good.
Dividends dividends
Paid to the
NCI.
non-controlling shareholders or interest. How much?
Working note 6 is 200.
That's it.
Interest paid from working note 1 is 1,480.
That is all.
So the net cash used in financing activities is 8,680.
Then adding up all the three, what is the net cash?
Net decrease in cash and cash
Is a net
equivalents.
decrease in cash because it reduced. If close, you see plus means net increase. It's negative. Net decrease in cash and cash equivalents.
Is 2,030.
Negative. And what is the opening cash?
3,900.
So closing cash is
1,000.